forward, what's the forecasts, and we will talk about what kind of factors are playing a major role in economic and market outlook, what the conditions would look like, what changes we're anticipating legislatively, and as also based on the new tariff laws and new regime that coming up, and how it might affect potentially stock market and economy. So let's talk about the economies first and where we see ourselves currently and what cycle level we're in. So you can see that the US moving toward the late cycle, and in the late cycle, usually the US large stocks do well. And late business cycle also means that there's certain areas of the market are overvalued. And it's not a surprise to all of us because since 2003, market has returned double-digit return north of 20% each year. So it would be very interesting to see if the third year of the bull market will continue. We have some ideas about it. We are not seeing recession, but we're definitely looking into more muted returns compared to last year. And there are a few reasons for that, which we'll discuss in a few minutes. Global growth increasingly depends on resilience of US economy. The size of the each circle depends on the size of the economy, GDP growth. So you can see that US GDP is the largest. That's why the blue circle is the largest. And ideally, you invest in the countries with the investment that has a long-term tailwind and also near-term tailwind. So you can see US and India on the top quartile there, and Japan is hovering over it, though Japan has a huge inflation issues with their currency. So it's not as straightforward as US economy. And everything else is not as attractive, especially opposite to it is China. China is in a contraction territory. They have a fragile growth. It's not the place if you are in retirement, low-risk investor. So based on this chart, you can see that the US economy and US markets continue to dominate the global growth, and seems like that's not going to change in 2025, which means that the theme for coming year, especially after the rate cuts, boosted stocks and bonds in a healthy territory. You can see the US stocks in non-recessionary environment produce a very nice return, followed by international markets. International markets are generally more correlated to US markets in the last few years because we're very interdependent. However, international markets, meaning non-US developed, that's Europe, Australia, Canada, they all have certain level of uncertainty for 2025, especially Europe. European economies are much more vulnerable due to their exposure to all the economic difficulties related to immigration. Also, their productivity and their earnings, corporate earnings, are not as strong. So if you're looking at risk reward, where you can make money with least amount of risk, United States still stays ahead of the game. The disadvantages of United States, is at least one I can think of, is the valuations. The valuations of US stock market is pretty high. It's above average. And the higher the valuation, the lower the expected long-term returns. This is something that we need to be aware of, because even though the US market seems to be the best place to be in the near future, over time, we need to be cautious of not overexpose ourselves to US should other areas of the market improve. For instance, if Europe starts to have a higher GDP growth, we need to look into European stocks as well. So you can see that cash start to lose its resilience, because as the interest rate starts to go down, money market and savings rate still will produce a decent return, but it's already past its prime. So we will not see money market paying higher rate. Most likely it's going to go down over time, especially if we expect at least 2 more rate hikes this year. In recession, also US stocks fall down less, which is great. And bonds, as the opposite, in general, would make money. I think if we do go into recession, which is, I think, unlikely, then the stock market will go down, but it's going to be a zigzag. The zag would be when the US bonds will start to improve, because people usually go to conservative investment during recession, number one. Number two, if they start cutting interest rates due to recession to stimulate the economy, you will see the bond prices improve. So the bonds right now, at this moment, especially after election, when the yields went up in an anticipation for high inflation due to tariffs, the bond price has gone down. So it's a great opportunity for those who are conservative, seeking good yield with low volatility. US bonds, especially multi-sector bond funds, present an amazing opportunity. Let's talk about federal funds rate, inflation, what we expect interest rates to look like. So inflation is contained. The target rate is 2%. We are close to that number. So US inflation is a dark blue. We are pretty much in full employment at 4% unemployment rate, which is very nice. It's a good long-term number. You can see that it was quite different. It was 14% during pandemic, but it went down very quickly. So we have two good indicators that pro-growth is a low unemployment. That means a higher consumption, and US propelled by 80% of its GDP is consumption. So consumers are strong, and inflation is lower now, much, much lower. So we're in a good territory. And on top of it, we can see that the projection for the federal fund rate to be lowered. So Fed continuously try to lower the rates, and we can see that market priced in about a couple of rates reduction already in its price. So rates are going down, economy will be stimulated, unemployment and inflation are low. So it's a perfect environment so far, if we're not looking into geopolitical issues, if we're not looking into government debt. So one of the major headwinds that we're anticipating would be managing the US debt. So US debt is increasing, and we will have a debt ceiling discussion very soon coming in the coming months. And depending how it's going to be managed, most likely how it was managed previously is they will have to raise the debt ceiling, and then they will have to pass the budget agenda. So once they pass the budget, we will know better where the cuts will be happening. They're talking about the cuts aggressively. You probably hear it. There'll be a lot of debate, a lot of up and down in the market because of that. So we expect 2025 will be a year where making money is going to be harder, and the overall returns is going to be, I think, lower. How much, hard to say, but I do expect to buckle up, because it's going to be a lot of headlines about debt ceiling, and the debt ceiling is not controlled. We'll try to control it. It's difficult to control it, so it's going to be a lot of debate and discussion about it before they pass the budget. So that will create a volatility. Probably sometime in Q1, we will see that debate start to appear. Okay, let's talk about artificial intelligence. Everybody is very interested in this topic. Some people say it's a bubble, others saying it's a reality. Well, for investors, this is the interesting comparison that you can follow. You can see that all the mega trends that appeared since 2000 in the last 25 years. First, we have a PC users that initial forecast was 225 million, but actual users were by 36% more. So even though a lot of us think that AI is overblown, out of proportion, in reality, it is overhyped, but it can be bigger than we think. Same happened with internet, 58% more. That's why we had that bubble, right? Remember internet bubble, all the companies that were on internet and then went bust. But the users of internet, the number of people who needed it was much more than anticipated. Same with mobile devices, 36% more people were using it. And now we see that the iCloud providers' revenue is actually forecasted only at was at $19 billion, but it surpassed it by 22%, in which it just started this trend. So I believe that artificial intelligence investment companies who invest in and related to AI would be the ones that probably make the most revenue. It's not going to be a one-year trend. It's a trend that will last years to come. If anybody interested how to take advantage of AI developments, you can see the infrastructure here built out that reveals the broad set of beneficiaries. So on the left side, you can see data center companies that will benefit. You can see that computer providers, semiconductor chip manufacturers, few names like NVIDIA. You can see that Microsoft, Amazon, Google would be a large beneficiaries of that. And also on the right side, the companies, they usually are not considered a technology company. That has nothing to do with technology. This would be power generators, power transmission. This is the power that needs to run the AI, and power needs to run the data centers. So utility companies recently have been doing well, and we need to uncover the companies that will, or power plant, large utility contractors, communications infrastructure. So all of this will be supportive of AI and needed for AI to develop. So we need to pay attention to how the AI changing the landscape of investment. So power is there, very important part of supporting the artificial intelligence running its algorithm, and we need to pay attention to the companies who provide that. AI opportunities in tech has a special stacking opportunity or ways of stacking them. So originally, we know that it was always a chip manufacturer in semiconductors. The largest companies would be Taiwanese TSMC. That's the higher end chip manufacturer that a lot of companies using, from NVIDIA to Apple, Broadcom, NVIDIA. All of these three are the major leaders in semiconductor production of the chips. And then infrastructure that provided to run the chips. It would be Amazon, Microsoft, their data centers, their structure, their systems, and then models. Who does the modeling for AI to work? The software development, right? So OpenAI, Alphabet, there's much more than that. Meta would be an application. They also have models. So there is few companies mentioned here, but there is many, many more. AI supply chain boosts all economy companies that not just our, we know all these names in technology, but there's also companies like mining, industrials, that can potentially benefit from the AI development. And there's few names on the right side that you can see mentioned. Constellation Energy, one of them. That's a big, beneficiary of the power demand. And you can see a few others that we can research and potentially allocate certain resources toward that area. Let's talk about the 7 mega caps, right? So we used to have magnificent 4 or 5, then it's mega cap companies. So the mega cap companies would be those that have the highest capitalization and the most prominent in the stock market, the largest, mega, huge, dominating companies like Amazon, Apple. Those 7, that's part of this magnificent 7, which is Apple, Amazon, Google, Meta, which is former Facebook, Microsoft, NVIDIA, and Tesla. So this 7 expecting to grow their earnings, but because they grew their earnings so well in 2023 and 2024, expectations that they will continue to grow, but their growth rate will slow down slightly. Where S&P X Mega 7, which is in yellow, will continue to accelerate. What does it mean? It means that the prices for an S&P 500 companies, except those 7 I mentioned, will continue to grow faster than mega cap. No surprise. Why? Because if we look at 2024, the market was not very broad in performance, meaning The largest companies did very well. The 7 ones did exceptionally well, but the rest of the market was lagging. Mid-sized companies, smaller-sized companies, the rest of the companies from biotech, from medical devices. But now the market overall performance broadening means those other companies are catching up. They're catching up. They're growing their revenue finally, and we will see appreciation in their price. So we need to pay attention not only to few names that we know that's on the top of everybody's mind, but also others that potentially can benefit from broadening of earnings growth. So that means including not only large companies, potential mid and small size companies in your menu or in your portfolio to diversify further away from just most expensive companies we know. Go small. This is one of the ideas that I hear across the board from many money managers, that US small-sized companies are very undervalued. This particular chart showing that since 2004, a long time ago, 20 years ago, that small companies were never so cheaply priced. So they're very undervalued historically, and valuations of them are very attractive. As a result, any good surprises on a small-sized company growth can boost them upwards in performance. If you notice, right after election, small-sized companies went up tremendously. They went up in 3 or 4 days, 10%, because it was an anticipation. If it's going to be administration led by President Trump, we will have a very good, strong economy, and small-sized companies benefiting that. That was a big surprise to many, though the conversation about small cap has been going on for at least a year. So maybe time has come. They haven't done very well in the last 10 years, and a lot of money managers do not include them in their portfolios anymore. But there is more and more interest to look towards small or mid-sized companies. They will do well only if we do not go into recession. But if corporate earnings growing, which we do anticipate the earnings growth to continue, then the small-sized companies should be able to pick up and produce similar, if not better, than overall market returns. This is my best and most favorite picture. It basically is showing all your earnings growth that we've seen, which is in blue, and different segment of the capital markets outside in US. And 2023 is showing yellow, and expected 2025. So if we look at 2024, you can see where was the best growth. Asia, you can see the Eurozone was negative, US was stable and positive, this is yellow. The last quarter in Asia and Japan start to grow more, and in 2025 we expect that the US earnings growth to continue. In Asia decelerate, in Japan decelerate, but US is strong. Eurozone potentially will come out of recession, so the first initial uptick will be there, but you can see the earnings growth in US is still double the Europe. So Europe presents more risk, still earnings growth, but not as high, where US continuously showing a positive momentum. So very nice picture to show you what we expect. Obviously things can change, but so far expectations for a first quarter and the second quarter of 2025 as a positive growth rate with earnings and as a result stock market. This is just coming from iShares BlackRock. They're the largest ETF provider. They give us outlooks here and there, and we pay attention, we read, we see what the reasoning. So they reason that US equity markets will be a continuously opportunity outside of technology companies. The fixed income, which means bonds, will be very attractive, especially outside of US, because the yields, interest rates outside of US in the sovereign debt is even higher than US. So diversification, not only within US bonds, but outside of US bonds is suggested. And they think that this is tactical allocation. Strategically, we believe that over time, international markets will pick up. emerging markets, China, Asia will pick up. They're just slower to come out of recession, after pandemic crisis, and also they're slower to recover from supply chain issues. So we are the first beneficiary. We've also printed a lot of money doing so, but other areas of the market needs to be watched. That's what we believe. Capex super cycle boosts Europe industrial titans. So Europe starting to wake up, and you can see that a lot of big companies actually do make money. We should not ignore them. So if you're making an investment outside of the United States, active management is probably more advisable. So you're not just buying an index, because index can include companies that are not profitable. But there is a lot of good companies overseas that are very large, and they're the big producers of goods and services that used across the globe. Opportunities in the emerging market is always difficult because it's not very transparent markets, but you can see that certain emerging markets, they are rising, and you can see that they've been attractively valued. If you look at the blue bar, it's a 10-year range, and the blue dot in the middle is the current valuation. So as we always talk about the valuation, so what's the value of underlying companies in this particular countries? You can see Korea, Brazil, and overall index, international index, is actually slightly undervalued. As a result, the opportunities exist. Taiwan is overvalued, India is a little bit overvalued. Everything else seems to be on a very good valuation and potential for appreciation. Let's talk a little bit about bonds and how they play and what kind of role they play in overall bond portfolio. Bonds present a very good cushion and income generation for those who are no longer relying on their income from employment. Also, for those people who are not willing to take overall market risk, bonds create a buffer, security, and reserves for you to use. And you don't have to be 100% on stocks in order to have a good, comfortable allocation. So a lot of times, bonds, and especially I believe in the next 5 to 10 years, might be able to produce a very nice return with a very low risk. Even though in the last 2 years, 2.5, 3 years almost, the bonds have been gone down in value because of interest rate gone up a lot and very quickly. Now we're at a time where the interest rates will be cut over time. As interest rates continue to go down, maybe not as quick as we thought, because inflation might continue to be a problem because of the tariffs, which we'll address in a minute. We still believe that the bonds will be a very nice place, part of your portfolio, especially for retirees, because A, they give you less volatility. B, they will grow in value over time as interest rates go up. And 3, because now they produce a very nice, decent interest and dividends that retired people can clip those coupons and enjoy the extra dividends from the portfolio. Let's talk about the tariffs. So from the most recent information I read, that if all the tariff law is implemented and as proposed, then we should expect to spend by $1,500 more out of our pocket for goods and services because they become more expensive. It is very likely that not all the tariffs will be implemented as proposed. It might take time, and the effect of the tariffs legislative changes might be gradual. We hope for that, because if there is all the tariff law comes in within the next 3 months, it's going to be inflationary. And if inflation again a problem, then interest rates will stay high, which means high mortgage rates, higher borrowing cost, slower economic growth. I don't believe the current administration wants that. So it's a balancing act between how much tariffs they want to impose and on what countries, and how we don't tip our country into recession doing so. So watch for this also. It's going to be and interesting to see how much will go into a legislative environment and what kind of tariffs are there, how they're going to be implemented. So we need to watch and see. I've been listening to a lot of outlooks from different sources, and some people believe that it's more of the conversation topic than actual reality, but we will see some changes. We'll definitely see some changes in the tariff going forward. We talked about the bonds again. It should offer a nice balance in years ahead, and it will produce a nice return, especially if there is any potential recession or any potential upset in the market. So bonds is a good place to be. Economic tailwinds support corporate and high-yield bonds. High-yield bonds last year produced very nice single-digit return between 7 and 8%. Very, very, very good. And I think they will continue to do well in this environment. And corporations also have a very healthy balance sheets, and they're paying on their bond yields, giving investors a coupon they can clip easily. So default rates are low, high-yield bonds are soaring, and we can look into that for a steady dividend production. Same as the dividend-paying stocks, by the way. That's also another good area to look into, especially dividend-producing stocks are not as expensive right now as technology and other large-cap stocks. We're not going to touch too much about the emerging market. That I just wanted to mention that there is a potential to look outside of US for bond exposure, but don't probably want to do it on your own because you need to let the money manager select those bonds. So just select a good bond fund that you trust through different maybe investment firms, and do due diligence, or let your advisor do due diligence on those funds, bond funds. All right, so I think this is almost our last slide. Municipal bonds, definitely a great place to be, especially for Californians. They do produce you a very nice return. They offer a strong income, and you see muni bonds tax exempt. This is the yield you can see, 5.8% currently. Some of us have been concerned about what kind of potential bond downgrade we will see because of the fire in LA, and we support all these people and hope they will be okay. It seems like municipalities in California have a very strong balance sheet, and the damage from the fire represents no more than 5 to 10% of the total reserves. So we should not see a lot of downgrades. The municipalities should be okay, though there are property tax payments will be reduced, and there's some government assistance coming to those municipalities from on the federal level, also on the state level. So yet to be seen, but doesn't seem to be concerning at this point. So we concluded our presentation. I touched on most important parts of the economic outlook and emphasized 2 areas, maybe 3 areas of the market to watch. One is to see how the legislative environment can affect the market. One of the legislative changes that we haven't discussed, that we have a Job Act law that was passed in 2017 during the first presidential cycle when Trump was in the House. And now this law is going to sunset as of January 1st, 2026. We have less than a year to either sunset all this law or make changes to it. I believe they will be doing some updates and changes, and there will be a lot of debates again, a lot of volatility because of that. I'm anticipating these discussions toward third quarter of 2025. And based on the new legislative environment, there'll be a new potentially tax brackets implemented. Also, we'll talk about the state tax exclusion amounts might change. There's few things that can change and then can paint a new tax environment. So that we need to pay attention to, very important, and most likely the changes will come toward the end of the year, if not sooner. So 3 things to summarize this year. A lot of political uncertainty. The wars are still not over, so we need to see how that's going to be resolved. Second is debt ceiling needs to be negotiated, and a new budget needs to be passed. And the third one is the new tax law that's supposed to sunset unless there are some changes made legislatively. So a legislative arena will be very busy this year. The second one is looking for opportunities outside of US large companies, broader markets. And the third one is making sure that you're taking advantage of bonds that, if needed in your portfolio, are there for reducing the volatility exposure in your accounts should the market continue to go up and down. So with that, I will conclude the presentation and we will address the questions. So I will go in and read a few.
Thank you, Larysa.
Thank you.
If you have any questions, please enter them in the chat box, or you can unmute yourself and ask Larysa directly. Somebody asked, what about Series I bonds?
Right. So I bonds is a good investment because they carry no credit risk. It's a government bonds. They have been paying a very nice rate. The only disadvantage of I bonds, they, I believe, have some limited amount you can put in. I believe per title, per account, it's I don't remember exactly the amount, but it's below 50,000. So it's great investment, but I believe it's a limited amount that you can put in. And as interest rates will go down, you just need to watch for I bonds rates. If you're holding onto I bonds for 1 year, you have to earn interest. You're earning interest every month, but if you get out of that bond before 1 year, you lose interest. So you have to be in the bond at least for a year. After 3 years or after 5 years, even if you break the bond and take the cash out, you can keep all the interest. So you need to be careful for how long you want to keep the money and what interest rate it's earning, how much you can put in. Otherwise, it's a wonderful investment. Yes, 1,500 means per year. Annual in, yes, per year, annual. Glossary of financial terms. Depending what kind of financial terms, we can use Investopedia if you're interested in a particular term. Let's say if you want to know how rate of return is calculated, what is ROI, or how is what is CPI, Consumer Price Index, what's in it. You can just go to Investopedia. They have a very good explanation there and very straightforward. Cryptocurrency, great question. Either purchasing as a storing or in one of the ETFs. Great question. Actually, I wanted to touch on it, and thank you for reminding me. So I do have few points to to address. So crypto appeals has largely been for its, we call it alpha generation potential. That means that something that we can gain outside of the stock market, because the crypto appreciation has nothing to do with earnings, with the economy. It's pure speculative, right? Supply and demand. So while Bitcoin's return have been impressive, they've come with extraordinary volatility, 4 times than of S&P 500. So moreover, unlike Bitcoin, equities or stocks are driven by predictable fundamentals such as revenue, earnings growth, which analysts can forecast to estimate future performance, which we did today. This market, cryptocurrency has nothing to do with that. So it's impossible to predict. That's very wild. That said, one area where cryptocurrency does potentially have value is its foundational innovation that underpins the assets, blockchain technology. So blockchain is a database, and how it's developed, how it's built, it's changing all the time. So a crypto can be a diversifier if you're able to sustain the volatility of it, if you're able to hold on to it long enough, or you're okay to lose the money in crypto, right? So right now there's exchange traded funds. It's basically a combination of several cryptocurrencies representing an exchange traded fund, and you can buy it. They can buy a few of them. You can do due diligence. Not too many companies selling it, but few. You need to make sure it's transparent. Crypto on its own is not a very transparent vehicle. So you need to be comfortable with volatility, no regulations, no government regulations, and not a lot of transparency. It's easy easy make, easy lose kind of situation. So you have to understand that, you can, it can go down without a notice, and you just need to be prepared for it. But it is there, the market is growing, so that's why ETF providers are now offering crypto ETF. If you want diversification and less volatility, ETF is a great way to do it because it gives you a return similar to combination of few cryptocurrencies. At the same time, you don't have to open an account and buy crypto. You can just buy ETF and follow it. It's like a gold ETF. It follows the price of cryptocurrency. So that's one way to do it. ETF's not a problem, and you can also open an account and buy individual crypto, but that's a different story. Don't buy those, bunnies or dog, whatever that is unknown. Buy something that has a big market, similar to Bitcoin or whatever you're comfortable with. Great question. Have there been any serious security breaches at Schwab, Fidelity, and Vanguard? I do not follow that. I know here and there we see security breaches. Probably better just to ask the representative of those companies directly. I'm not associated with them, so I think they're protecting their data, but you need to ask them. Thank you for glossary link here. Appreciate it. So investors.gov, great job. Thank you for that. Anything else on the question side?
It doesn't look like it.